there are multiple themes which has emerged, which earlier it could not have. So every segment has their winners. Actually ensures that you are searching for opportunities in individual segments fully and then making a portfolio out of it. But point is that what is the right price?
Hello and welcome to this very special series where we bring you exclusive and insightful conversations from some of the top voices from India's mutual fund industry, where we understand many of the investment styles that many of the fund managers have. And today I have such guest who is Shreyas Devalkar from Axis Mutual Fund. Thank you so much, Shreyas, for taking out the time to talk to us. You know, with this series, we're trying to understand how investment theses have been evolving, you know, as India's whole growth story has been evolving, right? Because how you might be managing a fund 10 years ago to now might be very different. You know, you have different investors, preferences and everything. So just wanted to understand how Axis's and yours investment philosophy has evolved over the past few years and what still has been the core architecture of it.
First of all, thank you very much for having me on this one. As far as Axis is concerned, generally the basic core of the philosophy, which is focusing on quality companies and growth, that remains at the bedrock. Reason being, generally quality companies, you see lesser drawdown. So when the market goes up, they may or may not participate so much, but when there is a drawdown, the quality companies really support. And obviously the growth. Now, when it comes to the current context and the evolution, is more to do with the economic evolution and the way economy has shaped up now and changes which we are observing last decade versus this decade. So to that extent, there are changes. So what is being observed is because of broadly global reasons, geopolitical reasons, there are multiple themes which has emerged, which earlier it could not have, especially on the B2B side. And they are in the capital goods space, strong power demand. They are in the electronic manufacturing space, where there is a need for world to shift away from China to India. They are in the new age technology space, which can be quick commerce or an application of technology. So there are multiple such themes which are emerging, and accordingly, probably say in last decade, the portfolio was more B2C oriented. While today the portfolios are more B2B oriented. That is more to do with the changes in the overall economic cycle. And that's where most of the diversified portfolios are actually getting oriented towards the B2B.
You know, you mentioned diversified portfolio, and that's been one focus that's been there since, you know, we've understood the concept of investment itself. But I think that also evolves, right? Because when you think of diversifying, right, you think, okay, this is a particular category. It's large cap, mid cap, small cap, then other sort of asset categories, right? Do you think that has still remained the same, where one should be focusing on these categories? Or how do you think that has also evolved, or at least should be evolving?
For someone who want to control their large cap, mid cap, small cap exposure, they can individually buy into large cap, mid cap, small cap, and they themselves can decide. But for a investor, as an investor, if I don't want to get into all these things, then it's better to get into diversified. Because it's not because large cap is better or not so good, or because mid or small cap is fast growing and will give you higher return. It's not because of that. It is more because there are certain opportunities which are more in large cap only. There are certain opportunities which are more in mid cap. There are certain opportunities which are more in small cap. So if you see, generally in the large cap, financial services has done well. In mid cap, the capital good industry. In the small cap, some of the hospitals, some of the chemical industries, and so on. So every segment has their winners. So when you buy a diversified fund, you can be part of winners across the segment. If you buy only one segment, then there is a chance of missing something. Secondly, if you take funds like Flexicap or for that matter, even the multi-cap funds, where fund managers, based on the opportunity, probably Flexicap may have more flexibility to move from mid-small to large and large to mid-small whenever required. While multi-cap may have a lesser opportunity, but still there is a possibility that fund manager can maneuver. So with this, in my opinion, over a longer term period, this kind of funds, a diversified fund where there is a mix of large, mid, small, because of which you can participate in multiple opportunities is better choice for the investor.
Right. You mentioned multicap, which, makes sense in many, ways, right? Because you need to understand how to diversify in all the segments, but multicap is the way to go. But now in this multicap sort of way of thinking about investment, how do you, or how would you, try to understand the emerging themes and try to put in those multicap, categories?
Generally, in multicap, actually, if you know that there are you have to have a minimum investment in large, mid, small.
Right,
So
right.
that actually ensures that you are searching for opportunities in individual segments
Correct.
fully and then making a portfolio out of it. So what it ensures that there are certain opportunities. Let's start with a small cap. So few years ago, it was about chemical, mostly the small cap opportunities. The opportunities are in CDMO now. Some of them are in small cap. Some of the opportunities are in spaces like capital goods as well. New age industries. Some of the software product companies are in the small cap. So these are the opportunities which generally you can capture through the small cap. There generally no one end up taking a macro call that GDP growth, inflation, etc. Midcap offers you the opportunity in capital goods mostly, because most of the great capital good companies are in midcap space. There are good real estate names in the midcap space. There are multiple segments of midcap which are in the consumer space as well.
Right.
So this is where the midcap offers the opportunity. And in large cap, you have opportunities which are established, well-established companies with diversified management, and it gives stability. There the growth may be more dependent on GDP growth per se, but there are still opportunities in travel tourism industry in the large cap also. So this is how when you make any multi-cap portfolio, you are participating the best of
Right.
all the segments, and because you have that mandate of investing into all the three segments, you end up choosing it wisely,
Right.
without any hesitation of whether mid and small should be high or low. And in this process, the portfolio becomes more robust and
Right.
long lasting.
Right. I think that's where at least the regulation comes into perspective, right? It's ensured at least us to have that. At least it's very investor focused, but also understanding like from the new age company specific, like does it also fall under the, any category sort of, or like how do you go about finding those new opportunities from the new emerging companies that we've been seeing?
New emerging companies, if you see, maybe I'll use the example of B2C as well as B2B. So in B2C segment, obviously we have seen a success of food delivery over the last multiple years.
Correct.
We can take that example in a hindsight because that is already established. Some of these segments, they start with actually loss making. It starts with the investors who are backing those businesses, their appetite for how long to make losses. It is actually the real crux of it, because these businesses make profit over a period of time. Now, when they come to listing, probably a large part of that loss-making process is generally behind.
Right.
Obviously, when you are getting listed, there has to be part to profitability, and that gives us opportunity that how to assess those businesses and assess, and based on that select those where there is a path to profitability. And normally path to profitability comes because of uniqueness, that there are not many competitor.
Right.
If there are a competitor, then generally that path to profitability becomes very tricky. And so we watch out on that industry structure, whether industry is emerging as monopoly, duopoly, or top three players gaining the bulk of the market. If you look at B2B businesses, so B2B businesses, actually most of the opportunities which has come recently in last 2, 3, 4 years in the market, some of them are in the power sector, but these businesses has been there for decades.
Correct. Yeah.
But when new businesses which came up, actually, they mostly came up in the electronic manufacturing services, or some of them have that EV play, but in the chemical industry or some other industries.
Right. Right.
Now, in this case, especially if you take a case of electronic manufacturing services, definitely the China plus one geopolitical issues, these are the trends which are, otherwise you would not have looked at these businesses. Otherwise, you would have said that the value addition is not there, or profitability is thin, etc. But then now, because of this, there looks like there is a possibility that this industry will emerge. And once this industry starts, first, always any new industry start with low value add, and then eventually it gets backward or forward integration to add more value.
And how does your frameworks evolve, right? Because when you try to analyze like a traditional company, then trying to analyze the new age companies, right? Of course, it cannot be the same metrics that can be used, right? So I'm sure in active fund management itself, it has evolved for sure in the last 3-4 years at least. When likes of Zomato and Paytm, all these new age companies started listing, and then I'm sure that must have shifted a lot. So how has that changed the philosophy or the investment style as well, at least for Axis?
Actually, investment style remains same. So it's not about only profitability and margins.
Correct.
Right? It's about actually we go back to always the Porter's 5 forces. That is the most crux of the investment.
Correct.
Profitability and valuation is mostly outcome of that. And when you then try to assess that what problem the industry is planning to solve, how is the competition emerging, whether new competition can easily come and disrupt the current business, because these companies are actually disrupting someone else's business model.
Right.
While whether someone else is going to come and disrupt your business model. Actually, these calls are very, very important. Now, these calls you have to take in the traditional businesses also, because in the traditional businesses, they have gone through that curve. So you need not actually, because now when you are manufacturing a transformer or you are manufacturing a boiler or turbine, that industry has gone through that curve. While this industry has not gone through that curve. And that's where the attention on, especially on the disruption front, has to be paid a lot.
Right, correct. Before I let you go, just wanted to understand, as an active fund manager, I'm sure you try to at least, if not, try to be ahead of the market, right? So there might be some certain risks and fears you might be at least watching for or preparing for.
As always, the risk has been valuation, but more so now it is getting built in mid and small cap space, definitely. The stories, the companies, and the growth prospect is really good. There is no question on that. But point is that what is the right price? And that has been always conundrum in Indian investing.
Yeah.
But that divergence is increasing a lot. And that's where, coming back to our earlier conversation, that to mitigate that risk, a diversified portfolio is better rather than going one way. Secondly, again, the geopolitical risks which are there, and those remain. It looks like that every year you are hearing something or other. The uncertainties are increasing, and because of which you have to be with the resilient business model. So what we are also trying to do is try to be with the resilient business model, because you don't know from where sudden some disruption comes. It can be because of new player backed by huge tons of money to incur loss initially in some businesses, to some policy changes or tariff changes, etc. So we have to be with the resilient businesses.
Right. Very interesting points you made, like how multi-cap should be the go, but also focus on the resilience business models, right? So thank you so much, Shreyas, for your time. It was great talking to you, and we will catch you on the next episode.